Hello, and welcome to Markets in Focus. My name is Joe Bell, and today we're going to talk about some of the most interesting financial market themes that I'm observing. So, a lot of key labor and inflation data has been released during the past few weeks. Labor market data has been stronger than expected, and September inflation came in above expectations, both of those impacting the Fed's decision at their next November meeting. But also, let's take a look at Fed funds rate and how restrictive it currently is relative to inflation. So we had the September jobs report come out recently, and it was stronger than expected. On the chart here, we show the U.S. unemployment rate. You can see this is the lowest that it's been in 3 months, just slightly dipped down to the 4.1%. But the real eye-opening information was that 254,000 new jobs were added in the month of September. Yes, many of them were government jobs. Yes, maybe it will be revised a little bit lower, but that number is well above the 150,000 jobs that were expected by Wall Street. And both the July and August jobs report were revised higher by more than 70,000 jobs as well. So with the unemployment rate ticking slightly lower, it is higher than it was during most of 2024, but the labor market remains in pretty good shape as we near the end of this year. Now, in terms of inflation, we had the CPI report released this week, and the September CPI year over year came in at 2.4% and month over month at 0.3%. You can see it's slightly elevated relative to the past few months. If you look at the 3-month annualized rate of the past 3 months, we're sitting at an annual pace of 3.3%. That's much higher than that 2.4% annual rate would show you. I think the combination between the strong labor market, somewhat pesky inflation, if you will, it's not elevated like we saw back in 2022, but there's no doubt we've seen a little bit of a pickup here during the third quarter in inflation. And I think this gives credence to the Fed only cutting 25 basis points at the November meeting right after the election. Just remember, we will still receive the PCE report along with another monthly jobs report. So both of those could have an impact as well. But if we look at how restrictive the Fed is right now, absent of those labor market and inflation reports, on the chart here, we have the Fed funds rate at 5%. That's the upper bound right now. It's between 4.75 and 5% target rate by the Fed. If you recall, that's 50 basis points lower than the peak rate of 5.5% that it was sitting at from July 2023 up through that September meeting, that more than year-long pause period by the Fed. So they finally cut it 50 basis points. But even after the cut, take a look. I mentioned CPI year over year came in at 2.4%. If you simply remove inflation from the Fed funds rate, it's known as sort of the real Fed funds rate. That difference is 2.6%. So even if the Fed cuts 50 basis points at the next meeting or the next two meetings, you're going to be sitting at around 4.5%, well above that year over year inflation number of 2.4%. So Fed is very restrictive. Whether they are a little more patient because of the labor and inflation data, which I expect them to be, or they even take 50 basis point cut. I think right now, when you look at the absolute difference, there's no doubt that they're very restrictive relative to history. In fact, that difference between those two is the largest difference that we've seen since 2006, almost 20 years. So very restrictive Fed right now, although we do expect perhaps only a 25 basis point cut at that November meeting right now. So obviously a lot of storms surging through the southeastern part of the United States over the past several weeks, and then Milton obviously during this past week. So I hope everyone out there in Florida and other parts of the South continue to recover and stay safe. I thought it was interesting. There's something called the Waffle House Index I wanted to share with you. Waffle House, the famous US, mostly Southern, a little bit up toward the Midwest, but mostly Southern restaurant chain, is known for having 24-hour, 365-day service. Now, the Waffle House Index has become sort of quote unquote unofficially a metric for FEMA and other areas to inform disaster response. That is tracking the number of restaurants that have actually reduced service or shut down completely as a sign of how impacted that area is. I think when I looked at the latest stats, it was something like 20 to 22% of Waffle Houses were closed. Obviously, that's going to change day to day. This was first brought up by a FEMA president in the past when they were in Florida during a storm, noticing that the Waffle Houses were still open and starting to track the dots in different areas to show, hey, when it's really severe, the Waffle Houses will close. So kind of an interesting factoid for during some of these emergencies that actually some public officials obviously are tracking is the Waffle House Index. So hopefully we get all those back opening and everyone stays safe. With that, I want to thank everyone for watching, and I'll see you next time.